Hello and good morning, listeners. It's Monday morning, and if you are having any blues, play some blind break to kick off those blues as we have an interesting week ahead. This is Almus Market Mornings, your daily dose of global financial update with me, Shikhar Garg. Now, there's been quite a lot of updates on the oil price capping front announced by the G7 nations, which Russia says it won't accept. OPEC Plus didn't make any changes in their policy after a whole host of volatilities in the expectations. US labor market shrugged any of the recession fears that they were having while also posting quite a strong wage growth number, keeping sentiments of Fed policy change uncertain. So, JK, these updates have been quite uncertain. So, what's your take? What are you thinking about all this?
Yes, Shikhar. So if when I looked at the data from US on Friday, I actually there is no consistent story to tell about the economy. You have a housing market recession, you have consumers who are hanging on, and then you have a hot labor market. So which one is going to guide the policy as far as Fed is concerned is where the investors are fixed. And by now, or rather for now, investors are hanging on to the current trend and pushing the dollar lower. And of course, there is one section of the analysts who are looking at the fact that the household surveys are still showing job losses, not job increases. And there is a two different angle in which the data is seen. So you have the market, which is initially up, or rather the dollar was up and then down, yields were up and then down. So even a well-known columnist in Wall Street Journal, he says the report keeps Feds being on track to raise the rates by 50 basis points on December 14, and underscores the risk that official rates above 5% in the first half of next year is a reality. So if the jobs report was a shocker because people went in with the lower expectation, and as we neared the report, there were even whisper numbers that the number could be as low as 100,000. But it was shocking. But the market moves after the knee-jerk reaction was even more shocking. 263,000 versus 200,000, and wage inflation doubling compared to expectations, and unemployment rate sticking at 3.7% would have ideally made for a sustainable reversal in the dollar's downtrend that was seen in the last several weeks, but that was not to be. And we saw the dollar come back down from the highs, and today it's trading at even lower levels against the major currencies, excepting probably the yen. And Chinese yuan has broken the 7 resistance, and now trades near about 6.97, even as reports emerge that there can be more relaxations in some of the Chinese cities related to COVID. The end of the day, Fed pricing for peak rate has actually moved down from 5% in May, coming May, to about 4.83%. And as I said, the household survey of job creation still represents a dismal picture. So eventually we will know what the Fed looks at, because we have the Fed meeting on 14th, and where even a new dot plot will emerge. Apart from that, we have CPI inflation for the month on 13th, which obviously Fed will be considering. And as we know, we are into the blackout period where no Fed speakers will be allowed to speak on a public forum. As far as stocks are concerned, Dow Jones rose marginally, but it was a 400-point recovery from the lows. S&P rose about 5 points, but again, that was a recovery of more than 50 points, and Nasdaq recovered as much as 200 points from the bottom, though it ended slightly negative. Interestingly, the VIX, the gauge of fear gauge of the markets, has fallen below 20 last week, and that had spiked to 34.53 in October. And even so, stocks still face more obstacles as the investors wait to see the index January downtrend has been broken. I feel current market steadiness is due to investors underowning stocks as they have fallen most of the year, and even as they prepare for uncertainties, particularly with major economies headed for a recession. We have an altogether different trend possibly in January, but we'll have to ride out the current trend. Key remains on how Fed reacts, and the markets look confident that even this jobs report won't shift the central bank away from an expected slowdown to a half-point hike in December. And as long as the traders feel confident the terminal rate will be under 5%, implying less than a percentage of point increase from current levels, markets are probably going to remain calm. Dollar was lower, obviously at 104.40 on Friday, and it is even lower today, as I said earlier. Then, of course, the big decision about OPEC deciding not to, or rather to continue the current level of supply to the global markets over the weekend, quashing fears of an output cut based on lower global demand. Decision came a day ahead of the start of two measures aimed at hitting Russian oil earnings in response to invasion of Ukraine. Those are the European Union boycott of Russian oil and a price of $60 cap per barrel on Russian exports imposed by the EU and a group of 7 democracies. Now, uncertainty rules as to how much the Russian oil, the two measures could take off from the global market, which could tighten supplies and drive up prices. But as of now, oil prices have gone up slightly, still awaiting how the Russia would react to the decision. The decision not to change output could possibly have also come because of feared supply shortage from Russia. So it's still a wait and see as far as the oil is concerned. And that is where the Indian stakes are high. Possibly the reason why the rupee has also not moved along with the other currencies higher against the dollar. And of course, the big hand of state-run banks has been present, consistently in the last few sessions, keeping the USD/INR above 81. And although we have seen good flows, November had seen more than 4 billion of inflows, and in December we are close to 1 billion of inflows already, and all that seemed to have been taken up by the state-run banks and the oil companies. As we have been seeing, the 1-year forward premium has fallen to 1.85%. That's low of last 10 years, more than 10 years. And exporters continue to wait for either a better spot level or a higher premium, but importers are happy to hedge at least near-term payables between 1 to 3 months at a lower hedging cost. So we still await a directional move in the INR. For me, a break below 81 and staying there for a couple of days would be the first signal. And also the upper side would be a break above 82 and staying there for a couple of sessions on the higher side of that benchmark. Lastly, just to share the technical part, that the dollar Chinese yuan offshore has broken an important support at 7.01, 7.00, trades at 6.97. Obviously, this is something that the technical observers look at, and the target for the break of this technical pattern comes around 6.70. That would mean move of nearly 8% from the weakest levels of the yuan. So how much it impacts the INR, even as it has already strengthened most of the Asian currencies, is something we need to wait and watch. Thank you.
Interesting, JK. And yes, there has been quite a interesting set of moves when it comes to currencies. Euro strengthening, GBP strengthening, yuan strengthening, yuan breaking major levels, as you've mentioned on the technical fronts. Folks, a lot of currencies have shown moves against the dollar, but it is yet to be seen in case of INR. But all in all, even the updates as we see, there have been good flows for INR. and Indian markets, but there still is a lot of uncertainty looming when it comes to the kind of policies the central banks are going to have, inflation data, as well as an impending recession. But we have the RBI central bank meeting this week, while Fed central bank meeting in the next week, folks. So a lot of updates are in our way. But I shall say, if you are someone who loves to keep tabs on business and finance, we have a mega event coming up, which you can join virtually. And it's Almus Rupee Money Conference, folks, one of the sought after events with a lineup filled with only and only stalwarts. Now, it's the ninth edition, and we see Almus have been trying to raise the bar only for you guys as high as possible they can. And it's going to be an interesting event, folks. A lot of insights, a lot of updates coming to you directly from the stalwarts. So do join in. That's it for today, folks. We shall come back again tomorrow with another round of updates.